Okay, let's get right into this explainer. Whenever we pull up a company's financial statements, it's really tempting to just assume we're looking at pure, unshakable facts. But the truth is, to really get a read on a company's health, we've got to put on our detective hats. We need to learn how to read between the lines of corporate financial reporting.
It's a provocative question, isn't it? Can you truly trust the numbers on a balance sheet? As analysts and investors, we have to recognize that financial numbers just aren't always objective facts. Often, they're the result of choices, estimates, and sometimes, outright manipulation. So today, we're going to unpack exactly how that happens. Here is your briefing document for today's investigation. We'll be covering the two types of quality, the financial quality spectrum, motives and opportunities, accounting choices, the non-GAAP illusion, and finally, spotting the warning signs.
Section 1. Two types of quality, the map versus the territory.
Now, this is an absolutely vital distinction. Financial reporting quality is all about the accuracy of the map you're given. Does it faithfully represent the economic reality of the company? Is it relevant, correct, and actually compliant with standard accounting rules like GAAP or IFRS? Earnings quality, on the other hand, well, that's about the territory itself. It asks, are the actual economic results generating a high return, and are those earnings truly sustainable for the future? Here's the kicker. You can actually have perfect reporting quality, a completely flawless map that accurately shows you a company with terrible, totally unsustainable earnings.
Section 2. The financial quality spectrum, because it really is a sliding scale.
Think about it like this. High financial reporting quality is just an absolute prerequisite. If the reporting quality is low, meaning the information is inaccurate or misleading, it completely ruins our ability to assess earnings quality or value the company at all. You can't judge the territory if the map is completely fake. Only when reporting quality is high can we actually figure out if the earnings themselves are solid and sustainable, or if they're tanking. So let's trace this quality spectrum from top to bottom. Up at the very top, we've got the gold standard. Reports that follow GAAP, give us decision-useful info, and reflect sustainable, adequate returns. But moving down the spectrum, we enter the gray areas. We see reports that are technically within GAAP, but management has made biased accounting choices to maybe obscure some poor performance. A step below that is straight-up earnings management, taking deliberate actions like deferring R&D costs just to massage the numbers. Keep going down and we hit non-compliant accounting, where rules are just flat out broken. And at the very bottom, outright fictitious transactions, pure fabrication.
Section 3. Motives and opportunities. Let's look at the psychology of the boardroom.
It is a really fascinating behavioral question. We actually saw this happen in the past with the CEO of Sunbeam, who committed accounting fraud despite having a massive personal net worth of over $100 million. Why risk it all? Well, to answer that, we've got to look at the environmental conditions that breed these scenarios.
These environmental conditions create what we call the fraud triangle. For low-quality reporting to happen, three elements usually come together. First up, opportunity. Maybe the company has terrible internal controls or an inattentive board of directors. Second, motivation. This could be personal, like hitting a huge bonus target, or corporate, like desperately trying to avoid a catastrophic debt covenant violation. And third, rationalization. The individual needs to internally justify the deception, basically convincing themselves that they're just smoothing things out or doing it for the good of the company.
Section 4. Accounting choices and estimates. The totally legal methods and tools.
Because companies use accrual accounting, which records economic events when they happen, regardless of when cash changes hands, they have immense flexibility. They literally have to use estimates. So imagine a company has a historical non-collection rate of 3% on its sales. If managers want to boost earnings to meet a Wall Street forecast, they might revise that estimate down to 2%, citing an improved economic outlook. That one tiny percentage point legally reduces their expenses and instantly inflates the bottom line for the period.
And it doesn't stop at bad debt. Even something as incredibly mundane as choosing a depreciation method gives management a massive lever to pull. Use accelerated depreciation and you report higher expenses in early years, which is super conservative. Use straight line and it's nice and steady. These choices are subjective, they're really hard to prove wrong in the moment, and they allow a company to either aggressively inflate current earnings or conservatively hide reserves for a rainy day. Section 5. The non-GAAP illusion. Get ready for a modern illusionist trick. Companies are relying more and more on non-GAAP or pro forma earnings. These are adjusted metrics that intentionally strip away the harsh realities of standard accounting rules. Management does this to present an idealized, highly flattering version of their profits. They're essentially saying, hey, look at what we would have made if you just ignore all these pesky costs.
Just look at what they typically exclude. Management absolutely loves to take completely real expenses like equity-based compensation for their employees, impairment charges, or litigation costs and just back them out. They'll claim, oh, these are non-recurring, or it's just a non-cash charge. But make no mistake, things like stock compensation absolutely dilute shareholders. They very much impact the true economics of the firm.
We can see this illusion perfectly in practice with Convatec. In their earnings release, the CEO hyped up a massive positive adjusted EBITDA of over $500 million. But if you looked at their strict standard GAAP-compliant income statement for that exact same year, it showed a severe net loss of over $200 million. They bridged that massive gap simply by adding back multiple required expenses. It is textbook proof of exactly how non-GAAP metrics can just totally divert your attention from a very harsh reality.
Section 6. Spotting the warning signs. Time to get our tools ready to catch these maneuvers.
You always want to be on the lookout for these red flags. Watch out for sudden, unexplained changes in accounting estimates, like suddenly tweaking the useful life of an asset just to lower depreciation. Watch out for companies pulling revenue forward, like conveniently switching shipping terms to FOB shipping point right at the end of the quarter, so they can record the sale the second it leaves the loading dock, rather than when the customer gets it. And definitely be suspicious when a company aggressively promotes non-GAAP metrics over standard ones.
Fortunately, we do have some disciplining mechanisms to help us out. Regulators, like the SEC in the US, enforce the equal prominence rule. This literally forces companies to show the unadjusted, standard GAAP numbers right alongside their magical non-GAAP figures, with equal visibility. Plus, they have to provide a clear reconciliation showing exactly how they bridge the gap between the two. So, as you apply these tools from today's explainer, I want to leave you with this final thought. The next time a company proudly announces record adjusted earnings, ask yourself, what are they actually trying to hide? Are they presenting a faithful map of their territory? Or are you just looking at a carefully crafted illusion? Keep asking questions, keep digging into those footnotes, and you'll always stay one step ahead.